Okay, good morning class. So again, in this lecture, we'll discuss the continuation of decision situations under relevant costing. So in this lecture, we'll be discussing sell as is or process further, continue or drop a segment or branch, and continue or shut down operations. Okay, so that's what you can expect for this lecture. Okay, so for our first decision situation, this lecture, we will discuss sell as is or process further. So from the term sell as is, we are referring here to joint products who can be further subjected to further processing. Okay, so um, as what we know, no, in some industries, a number of end products are produced from a single raw material input. No? When two or more products are produced from a common input or process, these products are known as joint products. So this is just a recall of your cost accounting. So at the split of point, or the split of point is the point in the manufacturing process at which the joint products can be recognized as separate products. Okay, so the term, no, if you can recall, the term joint cost is used to describe cost incurred up to the split off point. Okay, so joint costs are common costs incurred to simultaneously produce a variety of end products. So for example, in Dole, so we have the pineapple. Okay, so the same process, but they are subjected to joint cost of cleaning the pineapple, the slicing, the extraction of juices, and whatsoever. So there are a variety of end products. So we have pineapple chunks, pineapple slice, we have pineapple tidbits, we have pineapple juice, so on and so forth, right? Okay, so these joint costs are traditionally allocated among different products at the split of point. So the typical approach that we can remember is to allocate joint cost according to the relative sales value of the end products. So going back to relevant costing, which is our topic for today, joint costs are irrelevant in decisions regarding what to do with a product from the split off point forward. So therefore, this cost should not be allocated to end products anymore, but rather with respect to the sell or process further decisions, if it is profitable to continue processing that joint product after the split of point, if it can produce more revenue, then it is better to process further. So now, our decision question is, should the product be sold as is, or processing further will increase profits? Okay, so our decision rule is we process further if incremental revenue exceeds incremental cost. So therefore, we have incremental profit. So bottom line is we process further if there is incremental profit. Okay, so our data analysis format is we analyze the incremental revenue from processing further. So this is the selling price after processing. Okay, deduct the incremental cost to get incremental profit. So again, bottom line, for sell as is or process further decision situations, our decision is to process further if there is incremental profit. Okay, so time for self-check number 1. Okay, so we have here an example for sell as is or process further. So we have Pineapple Corporation produces product slices, chunks, and bits from a joint process. Joint production costs to produce slices, chunks, and bits were 600,000 allocated to the three products according to the number of units. Each unit product may be sold at its split-off point or processed further. So we have here the three products. So we have slices, chunks, and bits. So we have here the units produced. So that's 20,000 each for each product. So we have here the sales price per unit at split-off point. So we have for slices, we have 30, 40 for chunks, and 70 for bits. We have here also the sales price per unit if processed further. So we have for slices 60, chunks 80, and bits 90. So additional processing costs are 35 per unit for each unit processed further. So we have the requirement, which of the products should be processed further and why. Okay, so this is our solution. So we have here again, we are after the incremental profit. So we have here the incremental revenue column, the incremental cost column, and the incremental profit column. So for the incremental revenue, our incremental revenue is the increase in revenue if we will process it further. So here in the given, we have the sales price per unit if processed further. It's only 60. If we process it further, it will cost now 60. It will be sold at 60. But if you will just sell it at split-off point, it will just be sold at 30. So 60 less 30. So we have actually incremental revenue of 30 per unit if we will process that further. Now that 30 is our incremental revenue. Okay, so let's proceed to chunks. If we process it further, it will become 80. It will be saleable at 80. But if we will just sell it as of now without doing anything, it can just be sold at 40. So we have our incremental revenue of 40. So the same with bits. So if we process bits further, it will be saleable at 90. But if we will just sell it as is without doing anything, it will just be sold at only 70. So our incremental revenue is 20. Okay, so after determining the incremental revenue, we deduct the incremental cost. So it is given in the problem, additional processing cost is 35 per unit. So just deduct 35 from each product. So now we will get the incremental profit. So for slices product, its incremental revenue is 30. And the additional cost, incremental cost is 35. So we have a loss. Okay? So it's a loss, not a profit. So for chunks, so incremental revenue of 40 less the incremental cost of 35. So we have 5. Okay? So we have a positive 5. For zeta, for bits rather, so for bits, we have incremental revenue of 20 less the incremental cost of 35. So again, it is a loss. Okay, so again, it's a loss. So what would be our decision? So our decision based on this portion, we can only have incremental profit if we process further chunks product. So therefore, only chunks should be processed further. So again, bottom line, our decision criteria would be we will only process further if it will give us more profit, because that's the logic of it. Why would you exert more effort if you will not profit from it? Now, in terms of business, okay? Okay, so we have another sample problem for sell as is or process further. So we have here, Kodak company is selling a product for 100 per pound, which it partly processed at a cost of 60. It has been proposed that the 10,000 pounds that the company is processing monthly be further processed at a variable cost of 40 per pound of input to realize 8,000 pounds of completely processed product which can now sell for 200 per pound. Question: should the company process the product further or should it continue selling it as is? So, justify your decision. So, let's just take note the important details of the product. So, Kodak Company is now selling a product, currently selling a partly processed product which it sells at 100. Its initial cost for partly processing that product is 60. So, the proposal is that the 10,000 pounds that the company is processing every month be processed further to produce 8,000 pounds of completely processed product. So the current is 10,000 partly processed product selling at 100. So the proposal is to further process the 10,000 pounds and produce 8,000 pounds of completely processed which can sell at 200 per pound. Okay, so those are the important details of this problem. So let's solve. Okay, so again, the decision criterion for these kinds of situations is to process further only if there is incremental profit. So our data analysis format, so we have incremental revenue. So what is our incremental revenue? Our incremental revenue is 8,000 times 200. Okay, so we will get 1,600,000 less the processing cost of the 10,000 pounds times 40, the additional processing cost. So we have 400,000. So therefore, we have our incremental profit of 1,200,000 less sales at split off point that is being sold last time, 10,000 times 100, so we get 1 million. Okay, so we have a net advantage of 200,000. So if we process it further, it will give us 200,000 more net advantage, more profit. Okay, so because if you will just sell it now, or if you just put it or analyze it in a different way, if you sell it now, it will just give us 1 million. But if you process it further, it will give us 1.2 million. Okay, so our decision is to process it further for a net advantage of 200,000. Okay, time for self-check number 2. Okay, so let's proceed to our second decision situation. So we have add, retain, or delete a segment. So we all know that one of the most important decisions managers make is whether to add or drop a business segment. So ultimately, a decision to drop an old segment or add a new one is going to hinge primarily on the impact of the decision that that the decision will have on the net operating income. So you can do here the total approach or just the differential approach. Okay, so our decision question would be, is the firm or is the company more profitable with or without the segment? Will adding a new segment increase profits to the company? Okay, so what will now be our decision rule? Our decision rule is we add or retain if the segment revenues are greater than direct costs. Okay, so direct costs, variable and avoidable, fixed cost, or bottom line, as what we have already understood in responsibility accounting, we add or retain a segment as long as there is a positive segment margin, right? Because segment revenue less direct cost is what we call segment margin. So as long as the segment margin is positive, then better add or retain a segment. So we have here a data analysis format. So we all already know this. So we have sales less variable cost is equal to contribution margin less avoidable fixed cost. So we have the segment margin, okay, or the segment income. Okay, so let's answer self-check number 3. Okay, so let's have a sample problem for add, retain, or delete a segment. So we have here Ford. So Ford has 3 product lines. So last year, so the data in thousands are, okay, so we have Everest, Ranger, Premier, and the total for the company, Ford as a whole. So we have here sales of 230 for Everest, 270 for Ranger, Premier 360, and 860 for the total company. Variable cost, 120 for Everest, 150 for Ranger, 170 for Premier, and total we have 440. So these are somewhat familiar and already common because we already understood and we are done with the responsibility accounting. So we know how segment income reporting looks like. Okay, so we have unavoidable fixed cost. So we have 60 for Everest, Ranger 60, 60 for Premier, total 180. So as you can see, unavoidable fixed cost is in our responsibility accounting. This refers to the allocated fixed costs. Okay, so now we have the avoidable fixed cost. 80 for Everest, 50 for Ranger, 80 for Premier with a total of 210. Now, if you can look closely at these two kinds, no? So it can be recalled in our responsibility accounting. This is the allocated fixed cost. So as you can see, they are equal. Okay, so on this avoidable fixed cost, this is our traceable fixed cost. So this 80 is traceable only to Everest, 50 is traceable to Ranger, and 80 is traceable to Premier with a total of 210 avoidable or traceable fixed cost. So we have here our net income or loss. So for Everest product line, we incur net loss of 30 in thousands, okay? So Ranger, we have 10, net income, Premier, 50, and a total of 30 for the whole company of Ford. Question, should Ford drop the Everest product line because it is a negative? It is giving a net loss to the company. Should Ford better off if it will drop the Everest product line? Okay, so that is our question. Okay, so in this problem of Ford, looking at the segmented income statement, no, or the segmented income reporting, Ford's managers may ask, why keep the Everest segment when its segmented income statement shows a 30,000 net loss? No, so we know this that the from the concepts learned from responsibility accounting that the allocated or the unavoidable fixed cost can distort the keep or drop or retain or drop decision of the manager. So if we do a contribution margin approach or the differential approach, we look at the contribution margin here. So we have the contribution margin of Everest is 230 less 120, and that will give us 110 in thousand, 110,000. So we look at the unavoidable fixed cost, which is actually irrelevant because whether you retain or drop Everest segment, you will still incur that, but only divided into 2 segments only, right? Because it's unavoidable. It is the allocated fixed cost. So for this, if we include Everest, it is allocated into 3 segments. Okay, so if Everest will be dropped, if ever, this fixed cost of 60 will just be absorbed by the remaining 2 segments. So we have the avoidable fixed cost. So avoidable fixed cost, this will disappear, right? If we will remove Everest. So therefore, this avoidable fixed cost is relevant, no? Okay. So we have here our solution. Okay. So again, our contribution margin is 110. Okay. So we have our sales of 230 less our variable cost 120 and less avoidable fixed cost 80. So we have 230 versus 200, or we have a segment margin, a positive segment margin of 30,000. Okay? Or if we do it on a contribution approach, our 110,000 contribution margin actually exceeds the avoidable fixed cost of 80. So if you just do the differential approach, you will compare contribution margin 110 less the avoidable fixed 80. So you get also 30. So this is just the expanded view, but the same. So our decision is to retain prestige for a net advantage of 30. Again, remember, our decision criteria is to retain a segment if it gives us a positive segment margin. Okay, so that is our decision rule, right? Okay, so with going back to the question I asked a while ago, the managers may ask, why keep the segment? No, it already shows 30,000 loss. So this question, or the answer can be focused on the way we allocate fixed cost. So including unavoidable common cost of 60 in the analysis would make Everest segment appear to be unprofitable, right? Because it is negative. But in fact, the truth is, if we drop this product line Everest, the company's overall net operating income will decrease. So let's prove that using the total approach. Okay, so again, going back to Ford, let's show the analysis using a total approach. So we will look at the Ford company as a whole. A while ago, we just analyzed Everest. Okay, so this is a total approach. Okay, so again, let's look at the important, relevant details of the problem. So we have the contribution margin, 230 less 120. So we get 110,000 in contribution margin. So this income statement here show that if this Everest segment is dropped, the Ford company would lose 110,000 in contribution margin because you will drop this. So you will lose 110,000 in contribution margin. Okay? So we have here the unavoidable fixed expenses. So again, let's repeat. This will be the same whether we drop Everest or not. So the 180 total will still be 180. And again, the avoidable fixed cost. So since this is avoidable fixed cost, if you avoid or delete Everest, you can really avoid this. So this will disappear. So this is relevant to our decision. Okay, so let's look at the total approach. Okay, so total with prestige. So we have here the total sales of 860, variable cost total of 440, or in other words, we have the total contribution margin of, we have 860 less 440, 420. Okay, so we have contribution margin with prestige of 440. Okay, so if we delete Everest, okay, so if we delete Everest, we will lose that 110. Okay, so we will lose that 110 in this portion here. Okay, so as I've mentioned a while ago, unavoidable fixed costs. So for total with Everest, we have 180, and the total without Everest will still be 180. Avoidable fixed costs will be total with Everest, we have 210, and the total avoidable fixed cost without Everest will now be 130. So looking at these income statements, if we remove or drop the Everest segment, we will have zero net income. But if we retain Everest segment, the company will still have a net income of 30,000. So this complete comparative income statement reveal that Ford would earn 30,000 of additional profit by retaining the Everest segment. Because Everest segment has two things that can help Ford. First, it contributes the contribution margin, and second, it helps in absorbing the unavoidable fixed cost. Okay, so decision again is retain Everest segment because it can contribute 30,000 additional profit to Ford company. Okay, so we have here a second problem and still under add, retain, or drop a segment. So we have here apple juice has a central processing plant and 3 stores. Recently, profits have been declining. The projected income statement for the 3 stores appears below. So we have here 3 segments. So we have big, plus, and max, and the total for the company as a whole. So we have here the sales, then the product cost, we have the gross margin, direct store expenses, allocated administrative overhead expenses, and the net income, showing a net loss from big, net loss to 25 from plus, profit of 25 of max, and overall company net loss of 5,000. Question: which of the following alternatives will provide the highest profits for apple juice? Give the total net income from the decision made. So you have 3 options. Letter A, eliminate big because it is a net loss. Letter B, eliminate plus, again net loss. Letter C, eliminate big and plus because they are both net losses. And letter D, close all stores because the company as a whole generated net loss. Okay, so with our understanding and perhaps mastery of the differential approach, we will actually look at the segment margin. So when we decide whether to add, retain, or drop a segment, our decision rule, bottom line is to retain as long as the segment has a positive segment margin. Okay, so that is our decision rule. So just be reminded of that. Okay, so we have here for big, we have sales, right? 200, 175, 190 for max. So we deduct the product cost and the direct store expenses. So sales less the product cost, this will actually give us the contribution margin. So if we deduct the avoidable or the traceable fixed costs, we will get the segment margin. So as you can see here, let's start with big. So big has a sales of 200,000 less product cost of 120,000 less direct store expenses of 60,000. So big has a segment margin of 20,000. Let's go to plus. Plus has a sales of 175,000 less product cost of 100,000 less direct store expenses of 85,000. Therefore, plus has a segment margin. Actually, it is a segment loss of 10,000. For max, we have sales of 190,000 less product cost 110,000 less direct store expenses 35,000. We will have a segment margin for max at 45,000. So again, our decision criteria is to retain or add a segment as long as it has a positive segment margin. So therefore, as you can see here, plus generates a segment loss of 10,000. So therefore, our decision is to delete or drop plus. Okay, so let's answer self-check number 4. Okay, now, so we are now down to our last decision situation, and that is the decision to continue or shut down operations. Okay, so we have here key terminologies. So we have abandonment. When we say abandonment, it means permanent closure of business or stoppage of operations. Okay, so that is what we mean by abandonment or shutdown. Okay, so we have in this analysis the important terms like the shutdown point. Shutdown point is the indifference point represented in units between making a decision whether to continue operating at a loss or to temporarily cease operation. So again, this is the indifference point. So in CVP analysis, this is equivalent to our break-even point. The point at which whatever decision doesn't matter. Okay? So again, the indifference point is the point, the units, the number of units where our decision is whether we continue or it's shut down. So that is the shutdown point. Shutdown savings is the difference between fixed cost under normal operations and the shutdown costs. Okay? So we have shutdown costs. These are the costs incurred during the period of shutdown, which includes unavoidable fixed costs and startup costs. Okay, so we have here our decision question. Should a company continue to operate at a loss or decide to temporarily shut down operations? Okay, so what will now be our decision rule? Our decision rule is we continue if our demand exceeds shutdown point. So again, if our demand, the demand of our products exceeds the shutdown point, which is actually the indifference point, then we will continue. Okay, so we have here our data analysis format. So how do we derive the shutdown point? Shutdown point is equal to shutdown savings, which was defined a while ago, divided by the contribution margin per unit. Okay, so to further discuss shutdown savings, this is fixed cost under normal operations minus unavoidable fixed costs, okay, unavoidable fixed cost plus additional shutdown cost if there is, okay. So this is the shutdown savings. Okay, so the definition of the shutdown savings, fixed cost under normal operations less the shutdown cost, which is also the definition of shutdown cost, an unavoidable fixed cost and an additional shutdown cost or startup cost if there is, and divide them all by contribution margin per unit. Okay, so how did we derive this equation? So that is, this is also important. Okay, so if we have here sales with no operations, okay, so that's zero, right? Less variable cost without operation, that's zero. Contribution margin will be zero, so less shutdown cost, okay, less shutdown cost. So that's the loss for shutdown. So if we shut down, our loss is actually equal to the shutdown costs. Okay, so if we have the sales at shutdown point, if we continue, at shutdown point, we just continue but at the shutdown point, at the indifference point. So sales at shutdown point less the variable cost. So we have the contribution margin. If we continue, less the fixed cost for normal operation, we have the net loss. So that's how we derive the equation. Shutdown point is equal to shutdown savings divided by contribution margin per unit. Now, let's answer self-check number 5. Okay, so we have here a sample problem for continuous shutdown operations. So just continue to read. No? So we have Traders Enterprises is engaged in bottling of a vegetable mixture used for baking. So monthly production averages 200,000 bottles per month for the 3 quarters of the current year. Each bottle sells for 20 pesos in the market. So the annual fixed cost for traders is 7,200,000, which is evenly distributed on a 12-month period. The first quarter of the year is a critical period for traders. It is during this quarter of the year where the demand of the product is expected to go down due to seasonal variation. So during this period, the demand is estimated to be an average of 40,000 bottles per month. Okay, so the normal is 200,000 bottles production and the demand only for the first quarter is 40,000 bottles per month. On the belief that the company will be saved from greater losses, management is considering to shut down operations during the first quarter of the following year. A decision to shut down would decrease the fixed cost by 30%. However, during the shutdown period, additional cost of 140,000 is needed for security and insurance. To restart operations again, the company will spend another 50,000. So the following data concerning production cost per bottle are gathered from the records of Traders Enterprises. So we have direct materials 7 per unit, direct labor 4 per unit, variable overhead 3 per unit, variable selling expenses 2 per unit. So we have the total variable cost of 16 per unit. So the question, should traders continue operations or is it better to shut down operations? Okay, so for traders enterprises, we have the following requirements. Letter A, let's determine the shutdown cost. Letter B, let's determine the shutdown savings. Letter C, let's determine the shutdown point, which needs the information from letter A and B. And letter D, based from letter C, considering a decision to shut down or, shut down temporarily or continue operations. Which decision should be most advantageous to the company? Okay, so let's answer letter A. Let's determine the shutdown cost. Okay, so again, the shutdown costs are the total fixed overhead, 7,200,000, multiplied by our shutdown period, that's 3 months, because 3 months in 1 quarter, so 3 over 12, multiplied by the unavoidable portion of fixed overhead, as the problem states here that only 30% is avoidable. Okay, so we have unavoidable fixed overhead of 1,260,000. Then we add the additional cost for security and insurance, 140,000, plus the startup cost of 50,000. So we have a total shutdown cost of 1,450,000. So therefore, if we temporarily shut down our operation, we will incur 1,450,000 during those period of shutdown. Okay, so second requirement, let's determine the shutdown savings. So we have for fixed cost under normal operations, so we can save, we have 7,200,000 times the fixed cost for normal operations 3 over 12. So we have 1.8 million less the shutdown cost of 1,450,000. Okay, so if we continue our normal operation, so our fixed cost for that quarter will be 1.8 million. If we shut down for that quarter, we will incur only shutdown cost of 1,450,000. So therefore, we can save if we shut down in terms of fixed cost 350,000. So this is our shutdown savings. So we have here our shutdown point. So recall that shutdown point is equal to shutdown savings divided by the contribution margin per unit. Okay, so again, our shutdown savings is the fixed cost under normal operations less shutdown cost. So we have shutdown savings of 350,000 divided by our contribution margin per unit. As we can see here, we have selling price of 20 and variable cost of 16. So we have 4. So we have 350 divided by 4. So we have 87,500 units. So what does this mean? At 87,500 units, we are indifferent whether we continue with our operation and or we temporarily shut down operation. So we are indifferent. So we do not care. So either we continue, it's okay if we continue, or it's okay also if we just temporarily shut down. Now let's go to the next requirement. Okay, so our next question would be, considering a decision to shut down or continue operations, which decision should be most advantageous to the company? So it is already given here in our problem that the demand will be 40,000 per month. So that will give us a demand of 120,000 for the first quarter. So 120,000 will then be compared with what we computed the shutdown point of 87,500 units. So again, our decision criterion was we will continue operations if our demand is greater or higher than the shutdown point. So in this case, or in this problem, 120,000 demand in normal operations is higher than the shutdown point of 87,500. So therefore, we will continue under our normal operations because it is much better. So again, we have the decision criterion that as long as demand is higher than the shutdown point, then we should continue our operations. So that is 120,000 is higher than 87,500. So we better continue. But if you want more proof of our analysis, we can have this analysis. Okay, so let's start the shutdown units. Okay, so shutdown units, we have 0 units sold. Okay, so we have 0 contribution margin less the shutdown cost of 1,450,000. So therefore, if we shut down, we incur a loss, net loss of 1,450,000, and that is referring to our shutdown costs. Okay, so at shutdown point, which we have computed 87,500 units. So at 87,500 units, if we sell 87,500 units multiplied by our contribution margin per unit, which we have computed 4, so we can have contribution margin of 350,000. We deduct the fixed cost if we operate, and that's 1.8 million, right? So if we operate, we will still incur 1.8 million. Okay, so we will have a net loss of 1,450,000. So this is what is meant by the shutdown point. Shutdown point is we are indifferent, no? We do not care whether we shut down or we continue with operations because it will still give us the same net loss. If we shut down, we have net loss of 1,450,000. If we continue at 87,500 units, we have 1,450,000. Okay, so let's look. What if we have a demand of 120,000? Is it better? So if we have a demand of 120,000 units, multiply that by the contribution margin, so we will get 480,000 contribution margin. less the fixed cost. Under normal operations, we have 1,800,000. So therefore, we have a net loss of 1,320,000. Okay, so you can see here the difference, no? If we continue at 120,000 demand, we can have a net loss of only 1,320,000, which is better as compared if we shut down. Because if we shut down, we will have a net loss of 1,450,000. So better continue if our demand is 120,000. And this proves our answer. Okay, so let's discuss another second problem under continue or shutdown operations situation. So we have under normal operating conditions, Tribo Company manufactures 900,000 units of sandals in a 6-month period. Each unit of product contributes 1.6 to fixed overhead costs and profits. So therefore, this is our contribution margin per unit. The fixed overhead cost for 6 months amount to 640,000. Due to sudden closure of a major department store that buys this product at the start of the year, the sales projections of this product is cut to a rate of 40,000 units at a month. So only 40,000 units per month. The company management plans to close the plant for 6 months as they discuss tie-ups with foreign buyers of their product. The management expects negotiations to be finalized after 6 months. The fixed overhead cost can be reduced to 450,000 for 6 months if the plant is closed, but the additional costs to protect the facilities and to start up again have been estimated at 62,000. Should the plant be closed? So use shutdown point analysis to justify your decision. So we have here our answer. So we have our fixed cost under normal operations is 640,000. It is given here. Our shutdown cost is 450,000, the reduced fixed overhead cost, plus the startup cost and additional cost to protect the facility of 62,000. So therefore, our shutdown cost, if we shut down, is 512,000. So we will have a shutdown savings of 128,000. So shutdown savings divided by unit contribution margin. So we will get our shutdown point of 80,000. So therefore, again, we repeat, at 80,000 units, we are indifferent whether we shut down or continue operations. So now let's compare the data given for the demand. The demand here is 40,000 per month. So we are talking about 6 months. So 40,000 times 6. So the demand is 240,000. So what is your decision? Okay, so again, our analysis shows the following. Okay, so we have shutdown point of 80,000 while the demand is 240,000. So again, decision criteria, if the demand is higher than the shutdown point, then it is better to continue. Okay, so you can just do the analysis if you want to prove this, like what we did a while ago in the first problem. So again, our decision here is to better continue with the operations as the demand is higher than the shutdown point. Okay, so please answer last self-check number 6. Okay, class, so that's it for today's lecture, and next lesson coming up is relevant costing, lesson 3, techniques in decision making.